Okay, in today's Monday Mortgage Minute, we're going to talk about PMI. Why do we need it and kind of how does it work and show some comparisons. So let's start. Let's say you want to buy this $500,000 house, right? How much money are you going to put in? How much is the bank going to put in? Well, you're going to go to the bank and say, hey, bank, I need you to put 100% in, right? Which is 500,000. And they're going to ask, well, how much are you putting in? You're going to say, zilch, nothing. And the bank's going to say, look, I'm going to need some skin in the game, right? That deal ain't going to work for me. So then you're going to ask the bank, well, how much skin do you want me to put in there? And traditionally, they're going to say, well, I'll tell you what, I'll give you 80% of the money. You got to put 20% in. And that works out, they'll give you 400, you put in 100. And you're going to be like, I don't got 100 grand just sitting around in my checking account. So that ain't going to work either. So then it's a matter of, well, how much can you put in? And let's just say you limp in at, well, I can scrounge up, 3.5%, this tiny little sliver, and you give me the rest of the money, bank. So that equals about 17.5K. Now remember, there's a different video, but there's certainly down payment assistance that could help cover this for you. But at any rate, the bank's going to give you this, and you have to come up with this. Okay. So 3.5% down, that's an FHA loan, right? Do those every day. So let's break this down real quick in terms of payment, because remember this video is about PMI. So you got your loan size of 42. Yeah, you're buying a $500,000 house, but your loan's only 482 because, again, the other sliver you put in would be a down payment. Now, interest rates change every day. This is not a quote. Don't come at me, internet trolls. This is just an educational video. Let's say for grins and giggles, it's 6%. Let's keep the math easy on a 30-year fixed rate loan. Okay. So your principal and interest, about $2,900, taxes and insurance. Again, I know it varies. Let's just throw some numbers in there. Now your mortgage insurance on this is roughly $220. Okay. So all in, you're about $3,600. PITI, principal, interest, taxes, and insurances. Okay. This one is homeowners insurance. This one is the mortgage insurance. This is what we're talking about. Because you don't have 20% skin in the game, the bank's going to tell you, okay, you can limp in with 3.5, but I'm going to make you also buy an insurance policy. So if you skip town and stop making payments, or you default on the loan and we have to foreclose on that house, we have an insurance policy to protect us. Versus if you put 20% skin in the game and you do let's say a conventional loan, which we're going to cover next, then they say, okay, we won't make you add an extra insurance policy because you got enough skin in the game, right? Heaven forbid you foreclose, they take it back. There's still some money in it for them. If you just went 3.5% in and they have to, foreclose and repossess the house, there's some fees and costs that the bank's gonna incur, and they want to make sure they can get all their money back, right? That's why basically they make you do PMI. Okay, so conventional, instead of 3.5% down, now you can actually do 3% down. So it makes the math a little easier, right? Not doing a 0.5. Let's say same example, pretty similar, right? 2,900 a month in PMI, some taxes and insurance. Now, this is where it gets tricky. The previous one was FHA, right? That's a government loan. Government says, hey, it's a flat rate for everyone. And it's a pre-published chart, which I'll show you in a minute, and they don't care about your credit score. On a conventional loan, that's not a government loan. That's a private loan, right? So so they don't just set something for the public that's flat. They say, okay, it's going to be based on your credit score. It's going to be based on your down payment. It's going to be based on a whole number of things. So this PMI could range quite a bit with conventional. With FHA, it doesn't really range, right? So, you could be 3,400 and change, it could be 3,900 and change. See, I have question marks on these because you just don't know. Now, that's all internal. There's a whole list of factors that it runs, but certainly whoever you talk to can give you a quote for your specific scenario, your down payment percentage, your credit score, your property type, etc. Now, here's a little side-by-side chart. Let's say you're doing, somewhere 3 to 5%. FHA is almost always, not always, but like 99% of the time I feel it's 0.55% a year. Don't care about your credit score. Okay, so it's, it's a couple $100 a month. If you did 5, 10, 15, even if you did 20% down on an FHA, you're still going to have monthly PMI. They don't care. They always have it on there. Okay. Now, conventional varies widely. Again, credit score, down payment, property type, etc. And I've seen, these are just numbers I've seen over the years, because I can't run a quote until I have actually something in front of me with all those specifics. But I've seen, 100, under 100. I've seen as high as 400 or 500. And of course, when you get to 20% down, then you don't need PMI on conventional, but you still would on FHA, right? So where it gets interesting, honestly, is let's say you're putting 10% down, right? With FHA in this example, you're a couple $100 a month. Conventional, you could be less than that. You could be more than that. It just depends on your credit score. So certainly, whoever you're talking to, make sure we're doing a side-by-side comparison. I certainly do that for my clients. Whoever you're talking to, please ask them to do the same. Now, what is this one? Oh, yes. This is a little FYI behind the scenes. Maybe you guys don't know this. But again, we do an FH loan, the mortgage insurance is just set, right? It's the government saying this is what it is. When you do a conventional loan, the mortgage insurance, or the PMI, I call it, you have to go find an insurance company to do that. Almost like a homeowner's insurance policy, right? But it's a mortgage insurance. Now, there are 6 major mortgage insurance providers. What I do here at my office is I don't just push a button and say, quote me. We basically push a button 6 times. I look at every single major carrier to make sure you're getting the absolute best rate. So hopefully whoever you're working with does the same. Now, we talked about FHA and conventional. I want to bring up a third, and this is VA. VA is for veterans or folks that are still actively serving in the military. Now, they will do 100% loan to value, which means if you need 500,000, they're going to give you all 500. You have zero skin in the game, if you will, zero down payment. Now, their skin in the game is they've served the country. So clearly, skin has already been served. So they have earned the right. So they have zero down, which is awesome. The double benefit is they also have no mortgage insurance, even though there's no skin in the game, right? Zero down. Zero mortgage insurance as well. So it's a double benefit for VA. Don't let anyone tell you VA loans are bad. VA loans are awesome. In my personal opinion, they're the best loan out there. Okay, now, I know I'm talking a little fast, but I want to try to keep these as short as I can. Everything I'm talking about is monthly PMI, right? That goes in part of your payment. Just to review, conventional, it's all about your down payment, your FICO, your property type, and some other things. FHA, for the most part, is pretty much flat. VA doesn't have any, right? We covered that. So Greg, I don't know why we're recovering that. You're like, okay, Greg, I know that. But I also want to talk about right here, this is called upfront mortgage insurance. Now, conventional doesn't have it. FHA and VA are government loans. So they have a one-time fee. It's called upfront mortgage insurance premium, UFMIP. But it's wrapped into the loan. So what's the best way to explain this? They basically tack it on the back of the loan. You got your base loan, that's what everything's based off of, and then when you close, you actually have a loan a little bit bigger, 1.75% bigger on an FHA. It's not out of pocket. It's not like a buyer's closing cost. You have to try to get the seller to cover. It's none of that. They just add it into the loan. Now VA is, and there's a whole list of kind of a chart of different things, but it can be anywhere from 0 to 3.3%. Again, just a one-time upfront fee they add to the loan. Now, if you're receiving VA disability income, odds are you're probably going to get that waived. I see that all the time. So it's a 0. Or this is a little bit newer. If you're a Purple Heart recipient, it's going to be 0. If not, then it depends on your down payment percentage, if you're in the reserves or not, et cetera, et cetera. Okay. Now, then people always ask me, hey, when does this monthly PMI fall off? Okay. And the answer with FHA is never. It's on there for the life of the loan. Now, I do have a little tiny asterisk there, and I'll show you why in a second. There's a small exception window when that's not the case, but like 99% of the time, everything I see, it never falls off, okay? Conventional, remember, it's 20% going in to avoid having PMI, right? It's 22% on the way out when it falls off, okay? Or from a bank standpoint, 80% loan to value or 78% loan to value, right? Or as a consumer, you think 20% or 22%. And again, VA, it never falls off because it's never on there. Now, Just in more plain terms, when your house is worth 22% more than what you owe, right? In theory, you have 78% loan to value at that point, right? Okay, now I want to show you, this is the FHA chart. Most everyone falls right in this line right here. If you're under 726, for example, or even if you're over, then you're in this line here. But it's on there for the mortgage term, or otherwise I like to say for the life of the loan. There is this random exception up here. If you're 10% down, remember this is loan to value because this is what the bank's putting in. So think as a consumer, 10% down. If you're 10% down or more, or for example, if you're doing a refinance, right, and you appraise values here and you owe here and you got more than 10% equity, then it would fall off after 11 years of payments. But here's what's silly. Most folks aren't in their mortgage 11 years, right? They're probably half that amount of time because you're going to refinance. Rates are going to go up or down. You're probably going to refinance, or you're going to sell. You're going to move. Something's going to happen. Particularly if you're FHA, a lot of folks refi from FHA to conventional once their value's gone up and they got 20% equity. And at the time of refi, then the PMI comes off because you got 20%. So it's very rare I see someone in an FHA loan over 11 years that started at 10% down, right? But to be fair, that's how it works. Now, let's go through this example again. Let's say, again, you bought this $500,000 house. Let's keep the math easy. You put 10% down, that's 50. So therefore your loan size is 450, right? Okay, add that up together, you get to 500. Now, you're putting 10% in, the bank's putting in 90%, or they call it 90% loan to value. 90% of the value is the loan. The other 10% is your money, right? Okay, pretty simple. So year one, you owe 450, it's worth 5. It's kind of a same thing repeated here. 90% loan to value, 10% is equity. Hopefully we're tracking. Now, let's say year two, the amount you owe goes down, let's say 10 grand, the amount it's worth goes up 10 grand. And again, this varies from year to year, from market to market. This is just an educational example. So, just divide these two numbers, right? And you get 86% loan to value, 14% equity. So not quite the 22% we need on the way out for it to fall off, right? Now, let's say you're 4, 5, 6 years in, whatever. And let's say now you only owe 425 from the original 450, right? You paid it down to 425. Let's say it was originally worth 500, but now after a number of years, it's worth 550, okay? Well, here we go. There's our math. Now we're at 78% or less LTV, and we got 22% or more equity, right? Even though we still owe 425, the value naturally went up, and we're there. So does the PMI fall off? The answer is no, because it's based on the original value. You owe 425. The original value is 500,000. So technically, you're only at an 85% LTV, or you only have 15% equity in the sense of can it fall off automatically? Okay, so hopefully that makes sense. Remember, you started at 500, 78 LTV is actually 390. So once that principal goes down to 390, by law, it's going to come off, okay? But like in this example, you're in it a few years and paid it down to like 4 or something, and you have 20% value. Technically, if you're a few years in and you haven't paid it down, again, to the predetermined point yet, in this case, 390, but you think your value's gone up, you can call the mortgage servicers, that toll-free number that you make your payments every month, and you can ask them to remove the PMI. Again, this is conventional, right? We're not talking on FHA, conventional. You can ask them to remove it, and it's optional if they will or not. It is not required. My experience has been they're going to make you jump through a whole bunch of hoops, including maybe have you pay for another appraisal. And depending if you're close enough, if you've been in the home at least a couple of years, they have all these internal requirements. It's totally up to them because the law only says, hey, once they hit, in this case, again, 78%, 390. Once they hit 390, it comes off. But if it's before 390, it's optional. So that hopefully is a good summary of FHA. It's flat for everyone. Conventional depends on a number of factors. And VA, frankly, just doesn't even bother. So thank you for watching this part of the video. Hopefully this recording came through okay.
If you have any questions at all, just let me know how I can help. Free consultation, free pre-approvals, even free upfront underwriting reviews. Don't get stuck walking into your local bank or worse yet responding to some Super Bowl TV commercial you saw. You're getting ready to make potentially the biggest purchase of the year. Let's have a real conversation about your specific options and what's best for you. Let's go buy that house this year. Chat soon. Cheers.